Stock and bond valuations are a warning to investors. A warning, says Larry Swedroe. And we're going to look at this in just a second. We're going to look at this. I like Larry Swedroe. I enjoy his writing. I find the first part of this paragraph challenging. The last decade and a half rewarded investors with healthy stock and bond returns. But high valuations, low interest rates, and high inflation are signals to reassess risk tolerance and asset allocations. All right, I haven't read the whole article yet because I just said, have the last decade and a half really rewarded investors with healthy bond returns, Larry? Let's take a gander, shall we? So let me pause this real quick. Back to, let's see, we're going back to 2009. I got BND, the Vanguard Total Bond Index, as an ETF. Just remember, by the way, this is how old I've been around. I remember when Vanguard initially did not want ETFs. Jack Brennan, who succeeded Bogle, said, if you're a buy and sell kind of guy like that, looking for momentum, we are not your clients. And then they got beaten down by the board of directors. I don't know who it was, and Vanguard then offered sector ETFs and stuff. It was very interesting, actually, and I'm not sure if that's what led to Brennan's demise as a Vanguard CEO. I know when I was there at Vanguard, I'll never forget, they kicked Bogle out as CEO because he was 65 years old back then. John Bogle, RIP, has since died. I don't know if Brennan got kicked out because he had hit 65, but he was against the active trading of ETFs, sectors, stuff like that. It was good. I mean, he was a good CEO for the legacy of Bogle. I remember it was like yesterday. So I'm sitting there at Vanguard. Just by this time, I was in tech support. That's what it was. And they're getting ready to let Bogle go. And somehow I was in communication with Jonathan Clements at Wall Street Journal. I must have emailed him a couple times, and I don't know. I can't remember. And Jonathan Clements emailed me. He said, "You have any inside stuff on Bogle? Leaving?" I said, "No, I'm just a freaking peon. I think if I did, I wouldn't share it with you anyway, dude. You know what I'm saying?" But I got an email from Jonathan Clements asking me if I had any inside stuff on Bogle, being let go. I said no. And I remember. For some reason, my mom was very proud of me for doing that. She goes, "I'm very proud of you because she introduced me to Jonathan Clements' writing, before that." I said, "Why?" She goes, "Yeah, because it's an honorable thing to do to not give the company secrets away to a media personality." I said, "Thanks, Mom." That made me feel good. Still does this day. Anyway, point being is Vanguard had no inclination at all to do any ETFs, and then they did. But all right, so then I liked the Vanguard ETFs when they first came. I was a broker. I said, man, I like the idea of being able to charge my 1% fee, but instead of putting them in funds, because we couldn't have access to Vanguard funds back then because it was all proprietary, I liked the idea of being able to put them in Vanguard ETFs. But I always liked Ginnie Mae. And I said, why isn't there any fixed income bond ETFs? There were none. No fixed income bond ETFs. And I remember a guy, he and I, with a wholesaler for Vanguard, would go around Virginia we probably did maybe not, I can't remember, maybe 5 seminars in Virginia talking about Vanguard ETFs, introducing people to low-cost ETFs. It was fantastic. I loved it and enjoyed it very much. I said, man, but the problem is I still got to get the Ginnie Mae Mutual Fund, and we don't have access to that on our platform for fee-based. I said there's nothing replicable in that in the ETF realm because there were literally no bond ETFs. Isn't that crazy? Anyway, just a story from the past. That's what 2004, 5, 6, and then 7, 2004 through the middle of 2008. All right, so let's go back. I don't know why I went off that tangent. I thought it was interesting. So here's BND, which probably inception 2008, 2007, some of that, maybe 2006, probably 2007. And VTI, total bond index, total stock index. We're going to put 100% in each. 2 portfolios are going to go back to 2009, basically the last 15 years. And lo and behold, look at what we got. We got VTI has gone from 10,000 to 63,000, a 15.22% compounded annual growth rate. 15.22. Here's BND. Flat as a friggin' baby's bottom. 10,000 has grown to 14,600. Compounded annual growth rate of 2.93. Look at that. Great. Now let's do inflation adjusted. All right, so inflation adjusted, the BND is actually worth $723 more. So 0.7% more than what it was in 2009. The reason I'm starting 2009 is because that was the end of the great financial recession. Look at that. You've made $700 in BND over the last 13 years. Isn't that crazy? And even after inflation, though, you're up a quintuple for BTI. So if we want to go back to 2007, which he did say the 15 years, 2007. All right, what we got here? 2007, the compounded annual growth rate on BND is still only 3.2%. You haven't made any money. You just haven't for 15 years. I mean, this is gross of inflation. 10,000 grew to 15,000, a 50% increase over 15 years, which is a compounded annual growth rate of 3. Even with the Great Recession right here, $10,000, we lost 48% in the beginning of this. You're still a compounded annual growth rate of 10% per year over the last 15 years. That means you're doubling every 7 years. Yeah, exactly. 10,000, 7 years, 20,000, 7 years, 15 years, essentially $40,000. Inflation adjusted, BND, again, you're up 1.4% in 15 years. 1.4%. Look how that just looks like that's fantastic. Anyway, so I don't know what Larry's talking about here. I don't understand that premise because there hasn't been healthy stock and bond returns. I suppose you could look at the corporate bonds, I guess, but it just, I don't know. Go ahead, be my guest and do it. I don't get that fascination to say the valuations are too high on the bond market. They're just not, man. They're just not. Now, stocks will look at it a little bit differently because Larry does make a point about Anti's, I don't know how to say this guy's last name, Anti Ilmanin. He showed that equities perform best in growth up and inflation down, while government bonds have performed best in growth down, inflation up. Now, Anti-Ilmanin, you might not, you probably know, but he had written an article with another guy a long time ago to talk about active share and how funds that outperform the indexes have active share, i.e., they're not closet indexers. And I think he had written that in 2012 or something like that. And that took a lot of bullets or arrows fired at him, but the active share phenomenon it makes sense inherently. It's just logic. It says, look, if the S&P 500 has 500 stocks and you're betting on, say, 40, like the Vanguard Dividend Growth Fund only has 40 holdings or something like that, inherently, if you're right, you're going to be beating the S&P 500. If you're wrong, you're going to get trounced. It's just that simple. But the one thing you don't want to do is have a cosmic index of 400 stocks and charge 1.5 basis, 150 basis points. There's no way you can beat the index with that because you're mirroring the S&P 500 with a hell of a higher fees. Anyway, so I'm looking forward to reading that book by Anti. So, all right, love to hear your thoughts. We'll see you